Year to date in the stock market, we have seen some stocks like Uber perform very strongly, up 28%, but also other stocks like Tesla down 17%, and our focus is going to be on AMD, which continues to be in a downward trend, down over 8%, and one of the worst performing in the semiconductor space. Now we're going to run through our updated valuation based on the earnings to understand if this is a company to buy or one to avoid. And we also want to flag it hasn't had the great last 12 months, down around 35%, losing more than 1/3 of their market capitalization and isn't trading that far off their 52-week low. Having said that, both Wall Street and Seeking Alpha do consider this company a buy. However, AMD does face, according to this analyst, a double threat for 2025. And when we take a look, the main reason is in fact the company specific related to the data center business isn't looking as strong as the analyst wanted. And on a previous episode, we have in fact covered the amount of downgrades this company has had. At least 10 were covered, so do check that out if you want to see the specifics. But we can see that data revenue did come in at 3.86 billion. The market wanted 4.14, and that is quite some way away. And ultimately, analysts are worried that the strong growth we have seen in AMD's core x86 franchise is starting to slow down, and in fact, perhaps Intel is gaining some market share. That isn't the only issue, as we said, a double threat that AMD does face, but there is another one from ARM in the server CPU market, and as we can see, Microsoft and Nvidia have designed ARM-based server CPUs for their own cloud data centers that is increasingly taking share away from their x86 based chips made by AMD and Intel. And it also goes on to mention that potentially it isn't just an issue we are seeing on the server side, but also Nvidia could be about to make an ARM-based CPU for consumer Windows laptops, which would further cripple AMD's client business. As we said though, this is one that analysts are all in agreement that they believe this company is only going to continue to suffer from the competition it faces like Intel, like Nvidia. Yet having said that, their earnings continue to be very strong. They've outperformed or at least been in line over the last 4, and over the next 4 quarters they do anticipate double-digit growth to the earnings per share. And right now, believe it or not, based on the EPS for the full year, this company is trading at 23.3 on a forward P looking basis, which on the face of it does look very good. The sector itself sits around 26, so you're paying right now a discount to the median of around 9.3%, but you're also getting around a 45% discount to what AMD historically trades for, around 41.95. And there are some considerations we need to think about AMD in that whether or not over the long term it can continue to outperform the S&P like we've seen over the last 10 years. Not too long ago, we noticed Lisa Su, the CEO, discuss data centers in specific having a very large potential compounded annual growth rate of 60% at least until 2028. And this is the one segment that it will be very closely looked at least over the next few quarters, one that we just heard analysts were disappointed in for their Q4. However, we can see nonetheless up 69% year on year, and we also noticed their operating income was up around double from the same quarter in 2023. So whilst it did come under analyst expectations, we are still noting a lot of growth, and on top of that, in particular to the growth grade where they get an A, the earnings per share of this company is anticipated to grow at 43% over the next 3 to 5 years, which is not only significantly above the sector comparative of 15%, but also significantly above their own 5-year average of 33%. Now we're going to jump into our updated valuation as we mentioned for AMD, but before we get to that, we just want to highlight we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll also be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can grab a copy of 43 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now we want to talk about how we got to $137, which is essentially derived from the DCF model. Now we have here the free cash flow year on year, their latest earnings showing the 2024 amount at $2.4 billion, and average growth, we can ignore it for today's episode, as it does go from positive to negative over the last 10, making it quite inconsistent. Now 25% is what we are looking at today, which has been lowered from the previous episode of 30%, but we have both numbers which we will run through for those that believe slightly higher is more appropriate. But as you can see, low, medium and high, as well as Bloomberg, which we'll cover, these numbers as always are very subjective, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for AMD or any others. But based on 25% with the discount rate, then we get the present value of future free cash flows, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, $137, which indicates 23% upside. Now, if you do believe that is way too optimistic, then we can show you for full transparency the 20% rate, which would be $98, which would mean downside of 12%. We do also want to use the high rate of 30% because we also believe in today's episode you could argue the 25 or in fact 30, and you can see that would come to $190, indicating 71%. Now, we always have this Bloomberg figure here. It is to remind ourselves that Bloomberg a few years ago believed that the generative AI industry could be worth around $1.3 trillion, where they saw growth at around 42% on a compounded annual growth rate at least over the next 10 years, whilst also adding that software revenue would benefit significantly with around $280 billion in terms of demand. And therefore, when we do input the 42%, we get to $401, indicating 261% upside. That is more than a 3x from the current price. Now, we're going to go through two of them today. We're going to use both the medium and the high. So if we start off with the medium at 25%, we aren't just done yet because we do like to add a margin of safety at 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Where if you do believe that, in today's episode, a buy at $123, and we keep going till it's near the current trading price. Right now then, around the current value of $110, we see 20% MOS. Again, a reminder based on 25% growth to the free cash flow, and Wall Street themselves believe this company over the next year will hit around the $148 mark, which translates to 33% upside. Now, as we said, you could argue either the 25% rate or the 30%, which we will use again just to show you the difference between the two, as we've highlighted a $190 intrinsic value. And when we do run it through the margin of safety, no surprises, it will be a lot higher than the previous figure. You are getting at least 40% around the $114 mark, and as we said, Wall Street 33% upside. So give us your thoughts whether or not in fact you believe 25% to be more appropriate, 30%, or in fact 20% at the lower growth rate, and whether you're buying, holding or selling this company. You could believe a lot of growth over the longer term, or maybe one with a bit more short-term pain. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in a Patreon where we do cover our weekly buys and sells. We have been making some movements in the portfolio given the volatility over the last few weeks, and as always, have a great day. We'll see you all on the next one.